Hey everybody, Modified Darvas Box MDB coming at you here with another video on Friday, September 27th. And on this video, I want to talk quickly about the S&P 500 and the latest numbers, earnings per share numbers, which I got for that index. Before we get into that, quick background for people who don't know who I am. Basically, I'm a regular guy who created a strategy based on this book. Check it out on Amazon.com. It's a really great investing book. In a nutshell, I try to look for bullish Darvas box patterns that look like this, and I try to avoid bearish Darvas box patterns that look like this. Okay, so let's get into the earnings per share numbers for the S&P 500. So this here is the latest data here as of September 26, and the current index here, the current numbers, quarterly numbers are I've put here. I've rolled this forward because we're about to start a new quarter on October 1st. Yeah, the index is still only 97% reported. They're still waiting for a few more companies to report, but we're looking at about a 3% growth print as soon as they all finish out. And, between you and me, 3% growth sucks. In my opinion, it's the fault of the Federal Reserve for raising interest rates too high. But, they don't really consult with me on that. So, there's not much you or I can do about any of that stuff. What we can do is we can note what the forecast is. Now, for this new quarter we're going into, we're forecasted for a whopping 2% growth. Incredible, right? Now, you might look at that and get all nervous, like, oh man, this is horrible. But the good news is the market has probably 99% baked that number in. It's a known number. It's not really going to impact current prices because the market is forward looking, and it's looking at the future farther out than the immediate quarter. The good news is future quarters have better growth than the present. The quarter after, which would put it about January to March, is forecast for roughly a 34% increase in S&P 500 earnings. Now, 34% is exciting. And honestly, between you and me, that's probably what's been driving the market higher at this point. But the bad news is things don't seem to be going so well. And in my prior video, I showed a lot of stock charts of stocks that, with prices that are all dropping pretty fast. And that's probably because of this. The quarter afterwards, in my opinion, here in orange, is what the market is now beginning to focus on. And even though, yes, we are going to get double-digit growth in the farther future, what this 9% growth mark is, to me, it represents a dip, maybe a speed bump. But I think a dip is a better description. We get some good growth, 34%. Then we drop down, have a dip down to 9%, and then we increase again back up to 17%. So to me, this is how the market is going to go in the near future. We may have already seen this begin to occur, based on this week and the prior week. And who knows, maybe in the future weeks, there'll be more red weeks to come. And it would all be simply because the growth rate is slowing a little bit. But again, the good news is that the future is more positive, So every day we're taking a step closer to a more positive future. That's pretty much the best way to look at it. Valuation wise, yeah, at current closing, we're looking around 18 to 22 range. That puts us between an average market and a strong market. Well, if things are going to slow down a little bit into a dip, maybe the S&P 500 drops down to the lower parts of its Darvas box. maybe down to the 2800s. Let's say the index drops to 2850. Well, that'll make the index cheaper and a better value going forward. So who knows? I don't know where things are going to go, but based on this earnings per share forecast data, I'm predicting that we have a dip in the growth rates, which is going to lead to a dip in the market in the next couple months going forward. We'll see how this prediction plays out. In the meantime, if you have any questions, let me know. Have a great weekend. Talk to you later. Bye.